The Magnificent Seven, the top 7 hype companies out there, have fallen almost $2 trillion in value, from a value of $12.5 trillion down to a little over $10.5 trillion. Guys, these are the stocks that have driven the returns of the S&P since the beginning of the year. The S&P overall, I believe, is either even or down a little bit if you don't factor those stocks in. These have driven the entire return of it, and especially Tesla, Mo. Can you go over some of the Magnificent Seven, how they've done as of late?
Yeah, so look at this image right here. So these are the Magnificent Seven falling from their 52-week highs.
Wowzer.
As percentages, 29.3 for Tesla, 17.3 for Nvidia, 14.3 for Apple, 13.1 for Google, I can't see it. 9.5 for Meta and 8.5 for Microsoft. So
the average is 15%.
Yeah. So these stocks are, and remember, guys, take out the Magnificent Seven, market's down this year.
Yeah. And guys, we talk about this all the time. Avoid the hype. We sat there and you watch our videos. Everybody says you're dumb. You don't get it. Same thing we heard in early 2021 when we were warning about Neo, Nikola, Workhorse, Tattooed Chef, Peloton, all these companies. Everybody said, you're crazy, Palantir. You're crazy. Silence now.
Yeah.
Same thing will happen here. There are some good companies here, but the stock price versus the companies are very, very different. We think those companies are going to be around for a very long time, but it doesn't mean that their stock will go well. If you look at Intel, Cisco, Micron, all these companies from 23 years ago, a large chunk of them still have not gotten above their prices from 23 years ago. Guys, Pfizer just reported today. They beat on earnings. They were expected to lose 34 cents a share. They lost 17 cents a share. So they had a narrower loss, but they missed on revenue. They reported $13.2 billion versus $13.4. Another company, we sat there and said, guys, don't assume this COVID revenue continues. They did $100 billion in the biggest one-year time frame of their lifetime. And that was after COVID because of the COVID vaccine. Now they're down to $13.2 billion. Mo, what did they do in the same quarter? They did 34. No.
This is year to year.
Do the quarter to quarter.
Yeah. But even look at that year to year. 34.50 of 101.
Yeah.
Come on.
So quarter to quarter, same quarter last year, 22.6. They just reported 13.2, which is less than half of that same. Nope, not less than half, but it's almost half of that same quarter. Yeah. Guys, the COVID vaccine generated too much money. Just like we tell people when you're looking at airlines and cruise lines during COVID, you can't assume their revenue is going to be zero forever.
Right.
Just like you can't assume Pfizer and these companies can be forever at $100 billion.
When you look at a lot of the chip companies, when they doubled their revenue, you can't assume that that's the new normal.
And that was something we talked about. And of course, people said, oh, you're fudsters, you're okay. Guys, Fed reports this week. Fed is going to discuss what they're going to do. Mo, what is the market saying? Because every single time there's a Fed meeting, they always have like guesses, and there's always like, what are the markets saying? Sometimes it's like 98% to stay, 98% markets, Fed's rate's going to go up.
I looked at this earlier today, and I'm pulling it up right here. I think it's a 99 point. Let's see. Oh, it moved. Okay, so it's a 97.1% chance that it stays. Earlier this morning, it was a 99.
There's actually almost 3% that says it's going to decline.
Yeah.
Wow.
Now, I will say, over the last year and a half, this has been very accurate.
It has been, and core CPI, which what the Fed wants to do, is getting lower. Mm-hmm. The Fed focuses on core CPI. It takes all of CPI, excludes energy, and excludes food prices.
Food and energy.
I was sitting there going like, wait a second, what's the other one?
Pausing made me confused.
Yeah. So why? Because this was very volatile. Yeah. They're very, very volatile. So you sit there and they exclude them, saying we want to see where is the more stable inflation. And when core CPI is going down, they like seeing that. Maybe it's enough for them where they keep the interest rates the same. But guys, a year and 7 months ago, the rate was 0.
Just before we started recording, I was looking at the rates because I was curious where things were. 3 month, 5.46%.
It got as high as 5.5, Mo.
I know.
It did get as high as 5.5. And guess what?
10-year got as high as 5.
The yield is still inverted, which still is indicative of a recession, which we haven't had yet. But people are very confident. This means that we don't know what's going to happen. What we're trying to teach on this channel is to buy good companies at good prices. And if the prices fall lower, as long as the fundamentals and the thesis is the same, you continue to buy more shares. That's especially important. Guys, when I look at these interest rates and I see home mortgages now at 8% or more, on a 30-year mortgage. You're sitting there going like, how is this? But you know what they just did today? They just announced Case-Shiller. 6 months in a row, prices are up. Why? Lack of supply. Remember, guys, it's supply and demand. Whenever you're looking at anything, it's supply and demand. If you keep demand the same and you flood the market with supply, prices drop. Yeah. If you keep demand the same and supply down, prices go up. In this situation, demand dropped, but supply dropped even more. And that's why and the cost to build has continued to go up because of inflation. So you have all these factors working together that allow prices to still stay high. But you still see, though, when I see data, it is a supply thing right now because you look at data and the percentage of like rent versus buying, I mean, it's at like all-time high levels, even above 2007, 2006, 2008. Yeah. It's at really big levels. So who knows what happens in the future here? Remember, our goal here is to take the news and talk about it. We're not trying to make predictions where the market's going. But speaking of where the market's going, where has it been? I saw this on Twitter, and I tweeted it, and I said, I can't believe this is true. 2.5 years, and the S&P is essentially the same.
Basically the same.
4150 to 4184 in 2.5 years. Guys, at some point, if that continues, people are going to say, I need to find something else to make money in.
Can't make money here.
Can't make money, got to go find something else.
Yep.
And the pendulum will swing. We're at a very extreme level of overvaluation. Not as bad as 2022, beginning of 2022, but we're still at very high overvaluation levels. We got to swing the other side of the pendulum. There'll be a time in this channel in the next 5 or 10 years when I sit there and say stocks are massively undervalued. And you're all going to say, Paul, stocks won't go up. And you say they're under.
Money in stocks.
You can't make money.
Buy real estate. You got to buy this.
Okay. But luckily, you're probably one of the smarter ones who's going to subscribe to the channel and follow us to learn different things. Yes, guys, we are usually early to the party, but eventually the things we say will sometimes come true. I still believe Tesla is overvalued. I saw somebody the other day, right on Twitter. Some would argue that Tesla's still a car company. Some would argue. I was like, some are arguing that Tesla's a software, but he actually made it seem like Tesla was a software business, a tech company, and some are arguing it's a car company. So guys, Tesla's down 29%?
29%.
That's not up to date for today. However, Tesla's actually up today. It started the day down, and now it's up.
I saw it, last I checked, it was in the morning, that was up like 1%. Yeah, it's about 2% right now.
It got as low as 193 this morning, and now it's at 201.
Yeah.
Guys, Tesla's a tough stock. You have to sit there, and if you're part of the belief that Tesla is a tech company, then, yeah, buy it, because this price-to-sales ratio is low for a tech company. But I will tell you what's not low. I'll tell you what's really low, the gross margin that keeps getting lower. Tech companies tend to be 40 to 60% gross margin. Bottom line margin, 11%. Tech companies tend to be 23, 24, and upwards of 40%. So if it's a tech company, start making money like a tech company.
Yeah.
Guys, look at this. Here's the Magnificent Seven when I put them in our portfolio, or 8-pillar portfolio. Look at this. I put all 7 companies here.
Good companies overvalued.
$10.5 trillion market cap, free cash flow of $310 billion, earnings of $310 billion. I mean, we love this, right, Mo? Mm-hmm. We have a 5-year PE.
It's our favorite 8 pillars too. Well, 6 out of 8, I should say.
Yep. It's just valuation.
That's what our favorite ones look like.
Now, this is fine valuation if you think these 7 companies as a whole are going to grow revenue and profit by double digits for a long time. But can you honestly tell me that the top 7 largest companies in the world are going to grow their profit double digits for 10 or 15 years? If you believe that, guys, we're not the channel for you.
Is Nvidia still a $1 trillion company, or did they fall out of it?
Let's look.
Because
I think they got back to it today.
4 out of those 7 companies have a market cap
$1 trillion on the nose.
So there you go. That's a very difficult thing to do, for these companies to grow at the same rates, being over $1 trillion of market cap.
Well, to justify that.
To justify it, of course.
This revenue.
Not only justify it, continue to justify it for the next decade.
Yeah, and give people an ample return on their money.
Yeah.
So let's pull up Tesla in our stock analyzer tool.
I want to show Tesla on a chart too, because this is a very interesting one. We did live trading this morning on the channel, and this was a big topic of discussion.
So Tesla had an all-time high of 415. Mo, we'll get to that right before we do stock analyzer tool. Right. But at an all-time high of 414, wow. A low of 101 earlier this year. Wow. And now it's currently at 201. It hit 299 in July. So it's down 33% from its 1-year high. It's down over half from its all-time high. And the company is 2 years ago, it did its all-time high. And what's it done since then? Revenue's just done nothing but go up.
Yeah.
Revenue's gone from $75 billion in the following year, $46 billion in the previous year, to $95 billion.
So it's getting better and the price is coming down.
Yeah. So I always tell people when they sit there and say, oh, well, the stocks can go up because revenue and profit can go up. Okay. Well, you look at Cisco, Intel, look at them from back in 2020. The stocks have not recovered, and their revenue and profit are several times greater. Not several percentage points, several times greater.
Than 2000.
In 2000. 23 years, the stocks are still below their all-time highs significantly, and yet there's more revenue, several times, 3 or 4 times more revenue and profit now for each of those companies.
It's wild.
It is wild, and it can happen. And I do believe, I'm going to go in a statement here, I do believe of the Magnificent Seven, we're going to be looking at them in the next 10 years, and several of them will have a lower market cap than they do today. I would believe it's going to be Nvidia and Tesla being the market caps that are probably going to, I wouldn't be shocked if 10 years from now, their market caps are lower than today. Yeah. Please mark this down in the video.
I agree.
You think I'm crazy? You think I'm stupid? Please mark it down. But 2.5 years, if I told you 2.5 years ago the market was going to be flat for the next 2.5 years, you'd said, this guy's an idiot. This guy's so dumb. He's stupid. Guys, these 7 companies are the only reason these stocks have stayed up.
And you know what's funny about that?
What?
Nvidia and Tesla have been the ones that have probably gained
What
and
do we
lost
always,
the most.
What do we say?
Yeah.
The ones that run up the fastest and the highest and the most hype are the ones that come crashing down the worst.
Because I was looking at this saying, I could see the market cap for the other 5 being over what they are today.
I could see that.
These 2, I struggle with.
Now, Mo, go for the trading on Tesla.
So yesterday, our analyst Dalton, he's getting into trading, and yesterday he was talking about this big engulfing candlestick that happened. Now, this is completely independent of everything that we're talking about with the numbers. This is all based on this trend right here coming down. It has a downtrend. It had a good engulfing candlestick yesterday, and the best part about this, we're below the 200-day moving average. So there's like no big support from moving averages. So there is, if this thing can break, I do think it can get down to the 160s, 170s pretty easily. If I'm speaking Chinese to you, come and join me. We do live trading twice a week on the channel. So this is a big one that we're looking at, and Nvidia is the other one. So, and we'll get into Nvidia tomorrow.
Great. So let's see, if you're based on fundamentals, what Tesla may be worth to you.
Yeah.
Now, guys, I'm going to just pull up what we did last time on Tesla. The last time we did Tesla was September 18th. Here are my assumptions for Tesla back on September 18th. It's a 10-year analysis. And our stock analyzer tool, remember, folks, does not factor in the balance sheet. It's purely revenue, profit, free cash flow, and some multiple. I did 12, 18, and 24% revenue growth for the next 10 years, low, middle, and high. I did 5, 10, and 15% profit margin. Keep in mind, 10% still above most car companies, the mainstream car companies. Same with free cash flow. I did the same thing. PE, I did 18, 21, and 24. Same thing here. Keep in mind, Meet Kevin said that 70 would be a cheap PE for Tesla. It's currently at 60, Mo. So you should be putting everything all in right now. And I did a return of 12, 4.5, and 17. But here's what I'm going to do. I'm just going to put 10% across the board.
Okay.
This means, what's it basically, your market's going to get 9 or 10%. So what's it basically worth here based on these assumptions? Hit the analyze button. The stock's currently at 201. And guys, if you believe these highest assumptions, it's a buy all day. It's worth $400 a share. 150 in the middle, 43 on the low side. If you paid today's price and the low assumptions occur, which are still pretty good assumptions, you're going to lose 7% a year if you believe that every investment is the present value of all future cash flow. And when you buy a stock, you're buying a piece of a business. Highest assumptions will make 19%, middle assumptions 6.6. So, what do you think about that, guys? Yeah. It's kind of tough.
Yeah.
So, guys, everybody's going to be watching the Fed tomorrow. They're going to report what they're going to do. I'm guessing they're probably going to go by that 97.1%. They're staying the same. So, guys, you like the software, like the community. All I ask, we have a free trial, everythingmoney.com, 7-day full access, just like if you were to buy a car. You want to go take a test drive there. I'm asking you to take a 7-day free test drive of our trial. I'm not asking you to make a yes or no decision today. I'm asking you to sign up for the free trial and make a decision over the next 7 days. Use it fully, use our community, have the conversations about anything we've talked about. It's an engaging community with thousands of people, with tens of thousands of messages per month. Thank you very much. Everythingmoney.com. Go check it out.